In today's episode, we're going to be talking about money in the context of buying a home. When you buy a home, you need money for a down payment. You need money for closing costs. You need money for, reserves. And there's a lot of questions that come up about assets. So today's episode, we're going to spend a little bit of time and walk you through assets. This is going to be assets 101, if you will. So Josh, you're dealing on the loan side a lot. You deal with the asset piece of the puzzle. I rarely have to deal with the assets. But let's take a little minute here and just kind of talk about assets as an overview because, I say, people need to get pre-approved. I say, hey, you need to provide 2 months copies of your assets. And they're like, what are my assets? I thought it was, pretty simple term, but when we talk loans, we talk assets, what are we actually talking about?
The show today is truly frequently asked questions around money, the money that you need to close. And you do on the real estate side, Jeb, get questions. Well, when do I have to make my deposit? When do I have to have the rest of the money? So we're going to go through all of that fun stuff. But when we talk about assets, talk about the 4 C's of underwriting. The obvious ones are you need income. The obvious one, you have to have good credit. We talk about the collateral and the property being a good loan. And we've covered that in appraisal episodes before. This one is really about your cash, your money. So you need money for your down payment. If someone else isn't paying for it, either the lender or the seller or some other credit coming through, you need money for your closing costs. If you're going to establish an escrow impound account, you need money for your prepaids. And as you said, some loan programs, most in the context of first-time buyers don't, but some loan programs require you to have reserves, additional funds post-closing that you could use so that the lender knows you're not using every last nickel you have and you have a little cushion afterwards. So truly what we're going to do today is roll through all of those questions that you get, that I get every day, so that you can know with certainty what you're looking at. And remember, Jeb, for the context of the show here, we are dealing with primarily first-time buyers, primarily people using Fannie, Freddie, FHA, VA, sometimes USDA financing, jumbo stuff, DSCR loans, bank statement loans. Outside of the context of this, they're similar, but there can be differences. So I preface all of this by saying this is a good and accurate overview that's going to apply to 95% plus of situations, but have the conversation with your loan officer. If you're not working with me, you take this information, make some notes, go over it with your loan officer who's looking at your documentation, your approval, knows your loan program, and can tell you the accurate 100% answers for your situation.
Yeah, before we dive into what assets we're actually talking about here, I want to take a minute and ask a favor. If you find any value in our videos at all, do us a favor and hit that thumbs up. And if you want to stay updated on everything mortgage and real estate related, and support the work we do here, do us a favor and subscribe to the channel. So Josh, when we're talking about assets in the context of a mortgage file, applying for a loan, what are we actually talking about? What classifies? What is classified? Is that right? What is classified? What falls under assets?
So let's look at the simple ones, the ones that nearly everyone is going to have in their file. It's a checking and or savings account. You bank at Chase, B of A, Wells Fargo, the local credit union, the community bank, whatever it is, wherever your payroll gets deposited into, what you pay your bills out of. Most common, almost everyone's going to have that in their file. Some folks are going to also have additional savings that they might have in the current market. They might put it in a CD to get higher yield, a money market fund that gets them a higher yield. So those are all very liquid. Even the CD, you can break it, give up your interest, and pull your money out. So all of those are your funds in your account that we can use for closing. Now, some people also have investment accounts. They take extra money, they put it into a taxable investment account, different than a retirement account. So they have a Schwab account, they have a Robinhood account, whatever, where they're saving additional funds. Those funds are also liquid. They're a little bit different in that if we have them invested in stocks, bonds, mutual funds, we probably have to show liquidation prior to closing so that the underwriter knows that you're, $10,000 of Tesla stock didn't go to $4,000 of Tesla stock prior to closing. It's different than those liquid assets in the checking, savings, money market, CD. A lot of people, most people, I would go so far as to say, at least most employees, have some type of retirement account, a 401k. Teachers have 403bs, an IRA, a SEP, any of those accounts. Now, those are different because if you're not of retirement age, you can't just pull them out. You can access those funds, but they're a little bit different. Oftentimes we use those for reserves. Sometimes we have folks that are taking a 401k loan to provide usable funds. So they definitely have a role in the situation. So those are the most common ones. Jeb, we also get to the fun one. A lot of people say, hey, you know what? You're going to see my bank account is really never over $1,000, but I got $68,000 under my bed. So that is called cash on hand. Most loan programs are going to have some restrictions around that. So if you have a significant amount of cash on hand, let's talk about that in the context in a minute here of large deposits, of how we can season it, how we can get it into your bank account. But if you have cash, I've never had the problem of it being used. It just may be a time issue or a circuitous route to actually being able to use those funds. Big one in this day and age, less so than 2 years ago, Jeb, is crypto. People want to know, hey, can I use my crypto? The short answer is yes. It's going to be a little bit more difficult than most of the other types of assets. You're going to have to convert them to dollars. Depending on the loan program, they may have to be converted to dollars for a period of time. We have to make sure it's an account. Like, use Coinbase as an example. Super simple. We can show that's Jeb Smith's Coinbase account. And in Jeb Smith's Bank of America account, there was a transfer over from Coinbase. We show the Coinbase statement. We show that you sold all of your Dogecoin, and then we show the transfer over to your B of A. So you can use it, but absolutely, if you're going to be using crypto, let your loan officer know, because it's a little trickier than other types of assets. A couple of the last ones that we get, weird types of assets, Jeb, business assets. So you might have a business account. Jeb, you're self-employed. You probably have more money in your business account than you do in your personal account. On a day-to-day basis, you can pay whatever the heck you want out of it. Can we use those business funds as assets for you to close? The answer is yes, we can, but there's some additional tests and measurements there to make sure that we didn't use all of the money that you need to run your business, and now your business isn't going to be able to generate the income that we're using to qualify. And the last one, here in Southern California, we have a lot of foreign nationals. We have a lot of first-generation Americans, and they have either personal funds or gift funds coming from out of the country. So can we use foreign assets? Yes, we can use foreign assets. Much like crypto, we're going to have to be able to tie it to you or the gift donor. Oftentimes it involves fun things like getting translations of bank statements. So all of those are assets, and they are all usable, and they will all have different requirements of what we need to document and how we can prove how much you have to use for your closing.
All right, good stuff. Now, I think most people understand, what you just went over, but the question that people are typically going to have after hearing that is, how much do I actually need? Because that's the important piece, right? Doesn't matter where the money comes from. If I have it in 10 different accounts and you allow 10 different accounts, fantastic. But if I don't have enough of it, then I can't go anywhere. So when we talk about down payment, we talk about closing costs, we're talking about reserves. How does all of this mix in? How does a lender determine how much you need? Is there a certain requirement? Let's kind of go that direction.
It's interesting that you ask it that way, because a lot of times when we're doing a pre-approval, I say the most important things that you walk away from a pre-approval are, I can be qualified. Here's my max that I can be qualified for. And then here's my monthly payment and how much cash do I need? So when you finish your pre-approval, you should be really clear on what that number is. And it's going to be down payment. And if no one else is paying them in the form of seller credit, lender credit, realtor credit, you need to have funds for your closing costs and your prepaids to establish your impound account. And if the loan program requires it, which most of the loans we're talking about in the context of this program for first-time buyers are not going to, but if it requires it, you need to have your reserve funds also. So that's going to vary a lot. And it's a conversation that you're going to need to have with your loan officer. And Jeb, the variation of this conversation that I have most often, I will talk to a borrower and say, cool, when you're looking at open houses or you go online on Redfin, Zillow, and you're seeing homes that you would be interested and happy to live in the neighborhoods you want to be, what's that price point? I say, okay, it's $487,000. $5 million. I would love that. They'll say 500,000. Say, okay, plus or minus 500,000, what we're shooting for. And how much do you want to put down? they don't generally think in terms of, I want to do 3%, I want to do 5%. They'll say, I have $25,000. So the temptation is to say, okay, well, we've got 5% down. Well, we don't. We've got $25,000 to work with. So that's the clarification I'm always asking the borrower. So you've got $25,000 for your down, or you've got $25,000 total to close, because then we need to back our way into it. A really good example I have right now, a joint client of ours referred sister and brother-in-law, and we're looking to buy in Tennessee, $350,000 price point. And the max they can come up with is $15,000. We run the numbers. They need about $25,000. And there's no more, you can't get blood out of a turnip. There's no more money. So now we know, okay, we have $15,000 between sourced seasoned funds of the borrowers in their checking account and a gift, which we're going to talk about here in a minute. So to get the rest, now we know seller has to make a contribution, lender has to make a contribution, someone has to make a contribution to get that $25,000 down to the $15,000. So it's an important part of your pre-approval that not only do you dial in on the loan program, you then know total cash to close and where it's coming from.
Good. Now let's talk a minute here about reserves. What are reserves, Josh? And, again, I think certain loan programs require them. Other loan programs don't. So maybe talk about that in this context.
So in the instance of that borrower in Tennessee, if they got $15,000 and we get a $10,000 lender credit, we have nothing post-closing. They actually have some money in a retirement account, but nothing else that we can touch, nothing liquid. So let's say their payment is going to be $2,000 a month and they have $20,000 in that retirement account. Well, that would be 10 months of reserves. So $2,000 payment, $20,000, divide the 20 by 2, and it gives us 10 months. So the loan program they're doing doesn't require reserves, but they would have about 10 months of reserves. So it's funds left available after closing that you could use to pay the bills in an emergency. You get hit by a bus, you can't go to work next week, you don't get money. That's simply what it is. Now, when is it required, Jeb? That's really the more important question. Very rarely on conventional loans for someone who's buying their first property or will only own one property. On conventional Fannie Freddie loans, when you get someone that owns 3, 4, 5, 6, 8 properties, we're going to have reserve requirements. If you have someone who's less well qualified, a lot of times the automated underwriting system, even for FHA and VA that don't require reserves, it will give us an approval that it wouldn't otherwise for someone that has reserves. So we have one borrower with a 625 credit score and they get a refer ineligible because they don't have any reserves. Same borrower with $50,000 post-closing, it may approve them. The other area where reserves often come into play, if you're looking at buying 3 to 4 units, sometimes 2 units, you're often going to need to have reserves, even on FHA and VA where it's not otherwise required.
Now, when we say reserves, Josh, we know exactly what we're talking about, but reserves, same thing as the assets that we mentioned earlier, right? So it doesn't matter where the money is. It can be in a checking account. It can be in a savings account. It can be in crypto. It can be in all of these other places. It can be currently sitting in stock, right? It doesn't have to be cash on hand. Am I right?
It does not have to be cash on hand, but some of those sources have limitations around them. So it's an important conversation that you should be having with your loan officer. They should tell you, hey, we don't need reserves, or hey, we need reserves. We need 2 months in your situation. Where are we going to get it? Are these all of the assets? Everything you've provided here, is this the sum total of what we have? Because I need 2 months more of your principal, interest, taxes, insurance, HOA, total payment. So where are we going to get that from?
Now, just a follow-up question. So say, for example, you've got enough money in just your checking account, your savings account. Say you're putting, say you got $200,000 in there. Just hypothetically speaking, you're buying a $500,000 house and you're just putting, say, $100,000 down. You're putting 20% down. So you've got an additional $100,000 sitting in that account. Do you need to then go still provide 401k and all of these other assets that you have, just additional paperwork? Or are you just okay with being able to document what you need for that file?
Great point, and one of my favorite questions that I always go through with the borrower. When we do the initial pre-qual intro call, get your questions answered, and we say, okay, Jeb, we're going to move forward, and the steps to getting you pre-approved are, I'm going to send you a link to our online application and request for the supporting documentation. And it says 2 months banking account statements, banking and investment statements for all accounts that we're going to use for closing. if we're not using them for closing and your loan officer doesn't tell you you need them, and if you're just buying your first home or you're selling a home and moving up and buying, you're only going to own one home, don't do that. I apparently was not very clear on Monday when I spoke to a borrower, and he is very thorough, extremely well qualified. We have about 10 times as much money as we need to close, and it's spread across 16 different accounts. And I got 32 statements in, and some of these accounts have $5,000 when his main account has $365,000. I really just needed that statement. That's where all of the funds to close are going to come from. So sort of a corollary to that is, remember that a lot of times someone will have $100,000 in a money market fund because that's where they're saving their down payment. They want to get a nice return on it. And then in their checking, they might keep $3,000, $5,000, $7,000. But the reality is you're probably not going to be wiring from that money market. It's going to go into your checking, then into escrow when you make your deposit, when it comes time to make your final deposit at closing. So we're going to need that other account, even though we have so much money in the big account where all of your funds to close are coming from. Any account that funds go through in the transaction. So when escrow gives me a receipt and says, hey, we got $10,000 from Jeb from Chase, and I go, wait, I've got 2 bank statements in here that show he has $5 million in Bank of America. That doesn't work. Now I need to go and get...
That's not my account. You got the wrong account.
I doctored up your Bank of America account.
Fantastic.
But from there, in that situation, I have to go back and get that Chase account. And you and I, Jeb, we had this situation about a year ago with one of our favorite clients, awesome guy here in Orange County, Viet. Viet gives us all of his accounts, and they're all at Chase. And then the money comes into escrow. It's a different Chase account. It's an account that we don't have access to. And you would be shocked. When I talk to our processors, this happens all of the time. We have funds documented in the file, and then funds go to escrow from a different account. If you're going to wire funds into escrow, if you're going to write a check into escrow, if you're going to get a cashier's check and drop it off to escrow, I need to have that account sourced and seasoned so that we make sure there's not some random money out there from a rich stepdad who's giving you money at closing that we haven't sourced the funds.
Yeah, and we're going to talk about large deposits here in a moment, money coming from other accounts. But before we do that, I mean, I guess this kind of follows that same topic is cash. Not cash. Wow. Sorry, guys, listening here. Long, hard workout this morning. My brain is still processing the fatigue from earlier. Ability to gift. So donors' ability to gift. So you're getting gift funds. You don't have the money in your account. Maybe you do. Maybe you do have the money in your account, but still mom and dad have decided, you know what? We're going to give you the 20% down payment. We're going to give you the money for closing costs. How do we look at that? We've done an entire episode on gift funds. But just to kind of follow up here and while we're talking on the subject of assets, how is that used?
Again, Fannie, Freddie, FHA, VA, USDA, they will all allow gift funds. So what we need for all of them is a gift letter. And the gift letter lets us know who the gift donor is, their relationship to you, how to contact them to verify that they actually gave you the gift, the amount of the gift, when they're giving it to you, and most importantly, that this is truly a gift and there is no repayment required. Every program is going to require that gift letter. In addition to that, some loan programs are going to require that we prove the donor's ability to gift. They actually all require us to prove that the donor has the ability to make the gift. Fannie, Freddie, and VA will allow us to use the wire into escrow. So let's say you're giving someone a gift, Jeb, to close, and it comes in, it needs to say that it came from Jeb Smith's Bank of America account. And as long as we have that, then we say, well, Jeb must have had the money in his Bank of America account to wire it into escrow from Jeb's Bank of America account. FHA, USDA are not cool with that. They say, we want you to go one step further and get that Bank of America statement from your donor to prove that they have the ability to gift. So go through that with your loan officer because it's really important. I've had situations where someone has a donor who's happy to make the gift. They won't provide anything in terms of donors' ability to give. So we better make sure that we don't have to go FHA or have to go USDA. USDA would be less problematic because there's no down payment there, but it can paint us into a corner if we get towards the end and the donor goes, I gave you my gift information. I told you I'm making it. I told you my contact info and I wired it in. I'm not giving you anything else because FHA will require it. And you think I'm crazy.
No, it's funny you say that. I back when I did loans, I remember it's funny. Like The people with the most amount of money in their accounts have the biggest problem giving you additional information because they're like, hey, listen, I gave you what was needed here. I'm not giving you anything else. Like that is what it is. And so just understand it's, and oftentimes you'll be the one that gets blamed for it because you're the middleman in between the lender and the borrower. And they're like, why do you need this? And it's like, I don't need it. The lender needs it. I don't ask you for things that I don't need. I don't want any additional paperwork. And I think borrowers get fed up with you because you're the one asking. And it's like, hey, dude, I'm just doing my job. So have that conversation early on. Josh, cash on hand. How is cash work in this? You kind of mentioned that earlier. We're going to be talking about deposits here. Maybe we can kind of transition into deposits at the same time and talk about cash.
If you have cash on hand for Fannie and Freddie, they will only allow it on Home Possible and Home Ready loans. So you have to make 80% or less of the area median income. Even where programs allow it, such as FHA, there's likely to be lender overlays. So if you have cash on hand that you're going to be using and you are literally going to be in escrow in a week, so it's not like we can go deposit that money in the bank and wait it out for the seasoning, talk to your loan officer. What I would say is the most common thing in that situation is those funds end up coming back as a gift from someone, because in many situations, what we used to do back in the 90s, it was more common where everything was a manual underwrite. We would have the cash on hand. And what we would have to do is go through and say, here is the net income for our borrowers every month. Here is their budget, their rent, their auto payment, their insurance, everything. So they have a surplus of $620 a month. So to save this $6,000 down payment, they've been saving for the last year. That's probably going to be required. It just becomes a big pain in the butt. There's workarounds, but you want to talk about that up front. And that kind of, Jeb, is a good transition to what is seasoning. So let's say that you have the money. Yesterday, it was underneath the mattress and you had $62,000 there. But this morning, before you talk to your loan officer and get pre-approved, you said, oh, they don't allow cash on hand. I'm going to go put it in the bank. Now we have a large deposit. And that fund, so it's sourced. We can see it's in your bank account, but it's not seasoned. It hasn't been there long enough. So they make a step back and say, well, what's the source? It was cash. Okay, well, we can't prove that it was yours. It creates issues. So it is important that if you're going to bring cash in hand and put it into a bank account, if you have another large deposit of any sort, those 2 months bank statements, any large deposits in there. And what is a large deposit? One of the big questions we get.
Yep.
So Fannie and Freddie treat it as any deposit more than 50% of the qualifying income. So let's say in your household, you make $5,000 a month, your wife makes $5,000 a month. So we got $10,000 of qualifying income. Any deposit over $5,000 that doesn't clearly show, hey, came from the IRS, it's a tax refund, came from payroll at your job, anything that's not directly trackable back to something that we've already shown in the file, we're going to have to explain what it is. I had one here just recently that it was someone had a very wealthy parent who gave them a very large birthday present. And it was just a check, a random check that showed up. And we had to go back and we weren't using those funds to close. So we didn't really have to source it, but we did have to explain, what is this giant $10,000 deposit? And I said, can I get adopted by your dad? Because that's the kind of birthday present I want to get.
Well, let's go the other direction. You mentioned large deposits there. I want to kind of take a different approach here. What about somebody that has bank statements? You're providing bank statements to source these funds, and they've got money coming in from Venmo. They got money coming in from Zelle. They got money coming in from PayPal because they're getting different things. Maybe somebody's repaying them. Maybe it's a service. They've sold some things on different platforms, and that's how they've gotten paid. And now that money's getting deposited into their account. Is that something that has to be sourced? Do we have to go and source each one of those? Or because it doesn't qualify as that large deposit, we don't have to deal with it?
If you have 2, 3, 4, 5 Zelles, Venmos last month for $100, $150, adds up to less than $1,000, probably not going to be a big deal. But I'll see bank statement where it's like you said, someone has an Etsy store and they have 70 of them for $30 to $50 every month. We absolutely are going to have to explain what that is. And it has to make sense in the context of the file. For that person, we look and say, Schedule C sole proprietor that runs an Etsy store and they get paid electronically. So yes, all of those deposits come back to their personal account. It has to make sense. If it's just weird random stuff, you got a Zelle from Joe Johnson last week for $19,000. That's a large deposit. We're going to have to explain it. If you don't have a side job, nothing that we've documented, and just regularly you have Venmos coming in and out, they're going to say, do you have a gambling problem? Maybe not a gambling problem, because money's coming in, it's a good thing. You're obviously a very successful gambler. But this is what an underwriter looks at. And oftentimes, as loan officers, we're not super granular detailed the way processors and underwriters are. It is important that we look at those bank statements when they come in, that we look and go, okay, there's a $19,000 balance, but it started at the beginning of the month at $2,000. We just jumped $17,000 for a borrower who has a total of $9,000 a month income. That's an issue. So it's definitely something that needs to be looked at, need to be aware of up front, and sort of that context of seasoning the money, large deposits. Certain loan programs, specifically Freddie Mac, we can do 1 month bank statement. So I had one here very recently that we couldn't go Fannie Mae. We had to go Freddie Mac. And we talk about on the show here all the time. Those guidelines are 99% the same. Fannie's always going to require 2 months bank statements. Freddie will allow you to do 1 bank statement. Borrower was incredibly well qualified otherwise. They had a $235,000 deposit the prior month. So we could not go that route. We had to go, hey, here's the 1 month bank statement. It met the program guidelines, no questions, started the month with 235, ended the month with 238, no large deposits to be sourced. So this is really what your loan officer should be doing, is vetting that file, scrubbing the file, looking out for any potential problem, any question, not even a problem, a question the underwriter is going to ask, because we've talked about this before. You wrote the story of your life. I'm the editor. I want to polish it. I want to make it as pretty as possible so that when the reader, the underwriter picks it up, they go, that's a great story. I really like that. I don't even have any questions. They answered everything I could want to know.
If you're listening to this, that's why pre-quals are garbage, right? We often talk about getting pre-approved. Don't just get a pre-qual. Don't just have a conversation with a lender that you call online and go off what they say without providing tax returns, without providing W-2s, without providing asset statements, like Josh said here, looking at your credit. Because if I just tell you this stuff over the phone, hey, I've got $100,000 in the bank, and I didn't tell you that there were 5 deposits that were completely random that came from all of these different things, and maybe some of them can't be used because we can't source it, so on and so forth, your pre-approval or your pre-qual is as good as nothing, right? Go through the process, provide the documentation to make sure you're in, the best position possible to actually make an offer on a home. Now, if you're listening to this and you don't have a source, or maybe you're going through the process and you want another quote, our team here can actually guide you through that process. You can reach out directly to Josh, to myself, by using that referral link in the description of this video. And it will also get you in touch with a real estate agent in our market here, as well as our partners nationwide. So if you have questions, use that referral link. Use us as a source. We would love the opportunity to guide you through that process. Now, Josh, let's transition into large deposits in the context of what different loan programs are looking for, or does it matter? Does, when we're talking these deposits, does it change by loan program?
It does. And we touched on that briefly. So Fannie and Freddie, anything larger than 50% of the monthly qualifying income, we're going to have to explain it. For FHA, they're looking at 1% of your purchase price. So again, just use that situation, $10,000 of qualifying income, anything more than $5,000 needs to be explained. If you're buying a $500,000 house on an FHA loan, anything more than $5,000 is going to need to be explained. So there's a lot of leeway in there. You were kind of going back to those $300, $400, even $1,000 deposit. We may need to explain it, and underwriter may ask, hey, what was that? But we don't have to go through and completely source everything. Now, VA is silent on it, which doesn't mean that lenders don't set their own guidelines. They're going to use some internal measurement of what their trigger is, probably similar to FHA or conventional. USDA, anything bigger than $1,000, we're going to have to explain. So the loan program is going to kind of dictate what you need to do with that.
Now, good stuff. Now, earlier in the video, you mentioned I do deal with, assets in some way, and it really comes down to the deposits when people are buying a house. So one of the questions that we get as real estate agents is, well, let me back up. When you purchase a home, one of the things that you write as part of your purchase agreement is what you're willing to put down as an escrow deposit. Without an escrow deposit, you don't have a binding contract. So that deposit essentially binds the contract. Now, there's no prerequisite. There's no mandatory amount that has to go into escrow to have a binding contract. It could be $1, but the seller and the buyer both have to agree on it. And what I will say is, in the current market we're in right now, we're seeing a lot of 3% deposits, 3% of the purchase price. So if you're buying $1 million home, that's $30,000 that you're putting into escrow. Now, that's not money in addition to your down payment and your closing costs. It comes away from that. But the question that often comes up is, when does this money have to actually go into escrow? So state of California requires, based on the way the RPA is written, the purchase agreement's written, is that money, once you have both signatures on there and you have a fully executed contract, that you have 3 days to get that money into escrow. But that's only the deposit piece of the puzzle, Josh. We also have closing costs. We've got the rest of the down payment if they're putting more than 3% down. Sometimes they're putting money down and actually doing 100% financing. So they would be getting money back in some way at closing. But let's talk a minute here about when the rest of that money is actually due into escrow, because sometimes it's coming from, a gift. Sometimes stocks have to be liquidated and money has to be transferred. So let's, from the lending side, when does the lender actually need that money in escrow to be able to close on the loan?
Let's just look at a brief timeline of the loan. Jeb calls me up, says, hey, we got an accepted offer. I'm sending you the contract. We reach out to escrow. We get the third-party fees. We make disclosures to you. You sign those. We order the appraisal. We submit the loan to underwriting. All that comes back in. We get an approval, and we go back to the borrower. And we say, hey, we need X, Y, and Z. Those things come back. Underwriter signs them off. We're now clear to close. We can order your loan documents. Your loan documents go over to escrow, and escrow is going to prepare your estimated settlement statement. This is an important concept in here in terms of both the timing and the accounting. It's going to sound crazy because we tell you all the way throughout the process, the loan estimate and the closing disclosure are the gospel. The most accurate document you're going to have after the docs go out is the escrow officer's estimated settlement statement. So on your initial loan estimate, use that $1 million example with the $30,000 deposit. I will often get the question, hey, this says I got to bring in $212,000, but I don't see anywhere my $30,000 deposit. And say, correct, because I don't have a deposit receipt yet. I have nothing to show you've made that deposit. So under deposits, it says 0. So as you said, that needs to be in the first 3 days of the escrow period, but I'm not going to know about that for 7 to 10 days. So on your loan estimate, it's never going to show. But on your estimated settlement statement from escrow, they're the ones that receipted that in. Mm-hmm. They know all the money that's come in. They know every charge. So it is truly, if you ever in junior college took accounting 101, it's debits and credits. So you get a credit for every deposit you make, a credit for anything the seller is crediting towards you, any lender credit, any realtor credit. All credits go on one side, all debits, the sales price of the home, title, escrow, every fee that you pay, recording notary goes on the other side, and it's going to tell us the net amount that you owe. So even your closing disclosure may not show that deposit. It should show the deposit, but it doesn't always. So I will always defer before my borrower signs loan documents. I get the docs over to escrow. We get that estimated settlement statement. I'm going to send the borrower the note. And what does that do? The note tells them, this is what my interest rate is. This is my loan amount. This is my principal and interest payment. Very, very important. The first payment letter, so they can see, hey, those property taxes look like what I was expecting and agreed to. The mortgage insurance is right. That's my homeowner's insurance quote. Cool. That is exactly the payment I'm looking for. So I'm getting the loan I was promised. The payment is what I was told. And the estimated settlement statement confirms the cash to close, which is the net figure accounting for the fact that I already put $30,000 or whatever your actual deposit was into escrow.
The fact that you do that, Josh, takes a lot off of the stress of the borrower to some degree, and probably the stress of you worrying about what that borrower sees when they show up at the closing table to sign documents, and it's different than what they expected. I've seen it many times over the years. Borrowers call me and they're like, hey, I just got my loan docs, and this is different than what I remember signing or remember seeing. So, just make sure whoever you're working with, professional, is providing this, kind of guiding you through the process. You're not just showing up blindly to closing without having seen this stuff and knowing what you need to bring in, because, in some cases it can be a shock. And if there are questions, it gives you an opportunity to get them answered prior to getting there and then having to delay closing or signing something that you don't agree with and then having to figure it out. Because it happens both ways. But with that, Josh, I mean, you kind of went over everything with regards to cash here, assets, sourcing, seasoning, what a lender wants to see. Is there anything else that a borrower needs to know when it comes to money and buying a home?
Just to put a bow on this, I would say, other than knowing that you can get your hands on the money, the asset section of your file should be the least stressful. I've never had a borrower who could come up with all of the funds at closing, us not be able to find a way to make it work within the guidelines. Now, if you can't come up with the money, that's an issue. We need to know. We got to figure out if there's a workaround for that. But if you know you can get your hands on the total cash to close that I told you that we need, we can work within these guidelines. Income, it's hard and fast. Like, it's not like you can magically increase your income $500. Your credit, it is what it is. Unless we can do a rapid rescore. If that score comes in at 620 and the program guideline is 640, those things are pretty fixed in stone. There's a lot of wiggle room in here to dance around these guidelines and get a compliant file. So this piece, I say, do a very thorough pre-approval. If you have anything left or right of center, lay all your cards on the table, both in terms of providing documentation and telling your lender, this is what we're planning on, this is what we're trying. Because again, I can almost always figure out how to make a winning hand out of whatever cards you deal. I just got to know what we have. So do that planning ahead of time. Hopefully you have more than enough funds to close sitting in your checking account, seasoned source, been sitting there for 6 months and we've got no issues. But if you don't, do not stress. Just have a very thorough conversation with your lender up front.
You know, you said something important there, and I'm going to say it in a different way. Like your lender's almost like a therapist. Don't hide anything from them, right? Just lay it all out there. Let them take it, interpret it for you. And again, like Josh said, let them, create the best version of your story to present to the underwriter so that you don't have these issues. By hiding things, by keeping things, you're making, you're creating hurdles within the file that could be avoided by knowing it up front. So, with that, if you're listening to this, if you're watching it, let us know in the comments what you think about, this type of video. Do you like this type of content? What would you like to see more of? Because, that's what we want to create. We want to, provide you with the information that you guys want to hear, want to see. And if you found any value today, do us a favor and hit that thumbs up. Subscribe to the channel if you haven't done so already. And until next time, buy right, borrow smart, build wealth. Adios.
Amigos.